Hey everyone, welcome back to Coffee Time with Crypto with DJ and Ben and myself. Uh,
Yep.
and today we thought it would be a good idea to talk a little bit about stablecoins.
Yep. And I guess we'll start. Don't want to delay it anymore. So let's talk about stablecoins, but I'm getting out of character here. So even as a degen, I probably feel a bit scared during this current climate. Like everything that I've degened on is down. So maybe it's probably time for the average degen out there to maybe go back to some kind of fundamentals, at least know what a stablecoin is, right?
I was
So
just gonna
like for
ask
me,
you, I was just gonna ask you, is this even in your degen vocabulary? What's a stablecoin?
No, not at all. Like honestly, stablecoins, who likes stablecoins? It sounds boring. It's stable. Like as a degen, we don't want anything that's stable. Um,
So what
so I feel
do you know
like,
anything about
yeah,
stablecoins? Do you know anything like
like the
if
only thing
you
I know
yeah, if you were to explain stablecoins to someone who was not in the crypto space as a degen, how would you do that?
as a degen, basically it's anything that's pegged to the dollar, to the US dollar. So the only ones I know of are like USDC, USDT, or maybe UST. And then there's also I feel like even stable coins, I feel like there's degen stable coins. So at one point of time, I thought Magic Internet Money was a actual stable coin.
It is.
Um, it is, right?
It
But
is.
it's something about it. It's like a degen stable coin for some reason. But because I don't really know what the ins and outs of it is, and I don't know what the differences are between them.
Okay.
So let's
So
start off by
let's
you
walk back.
explaining.
I think it was a really good quick definition of stablecoins, which is everything that tries to peg itself to to a
Tries.
currency is considered a stablecoin. So the most popular ones are going to be pegged to the U.S. dollar, and you mentioned quite a few of them. Uh, so you have USDT, which is Tether. I think that's one of the ones that you mentioned. Uh,
Yeah.
that and USDC, which is the stablecoin from Circle. These are
Okay.
examples of stable coins that are uh, they're backed by traditional assets. So, for example,
Okay.
Circle, um, they are pretty much they used to not be fully backed by the U.S. money market um, equivalents, let's say cash equivalents, but I think they are at least my understanding is that they are currently fully backed by things like treasury bills and
Oh, okay.
bank deposits and so it's that kind of thing. Whereas Tether, this is one of the controversial things that are in the blockchain space where uh, nobody really knows what is
Oh,
what is used to back Tether. Um,
okay.
they so the only reason we know anything about Tether is because they had these lawsuits where I think it was the New York Department of Justice. They were able to get them to disclose roughly what they held as assets, and it was revealed that at least a significant part of what was backing Tether was commercial paper, and commercial paper um, are not short term treasury bills from the U.S. government. They're basically short term bonds or from companies, or who knows what kind of company. And so
Okay.
they don't give their credit rating or anything like that, and so that's a problematic thing. So we know for sure that Tether isn't fully backed by treasury
Hmm.
bills or any kind of cash equivalent, uh, and so Circle, like the USDC, which is issued by Circle, and in partnership with Coinbase, I believe, uh, they
Okay.
they are really aiming more to be um, like a more trustworthy version of the traditional asset-backed stablecoin.
Mhm.
Um, so there are generally two types of stablecoins, right? You have stablecoins that are collateralized, and
Okay.
if they're fully backed, that just means that there's it's fully collateralized, and that's what you really want to see in a stablecoin,
Hmm.
where if you have one, let's say USDC, that's issued, you want hopefully that they have $1 or equivalent somewhere, that's custodied in a bank or something.
Hmm.
Um, so the problem with those is that it's still a centralized thing. So it's either Circle or
Mm.
some bank is holding these bank reserves, under deposit. So that's
Okay.
kind of goes against the whole ethos of cryptocurrency and decentralization. So that's one of the
Yeah.
main criticisms of um, these types of stablecoins. So
Yeah.
they're more like the centralized stablecoins. The other
Mm.
type of
And I'm guessing the
stablecoins,
centralized ones are the stable ones, the actual trustworthy, reliable ones.
well, the thing is, they're if we set aside Tether, because Tether
Yeah.
is also centralized, um, and I wouldn't necessarily say that um, it is trustworthy in the sense that it's been around the longest and it has the most liquidity. But in
Hmm.
terms of when we evaluate it from a traditional perspective, whether it's fully backed by U.S. dollars, then we can't
Hmm.
say that it's as trustworthy, at least from in
Okay.
my perspective. So just to remind everyone that we're not giving financial advice here, and
Yeah.
um, this is entertainment and education. You should do your own research, and we're just sharing our experience.
Yeah. Yeah.
So
So go
yeah,
ahead.
go on.
So like what like as a person in crypto, like why do they why do people use a stable coin? Is it just to hold value or like a placeholder of your money when you don't know what to degen into?
Yeah, I mean that's exactly it. I mean the whole reason for stablecoins is that you don't every time you want buy or sell cryptocurrency and you want to convert it from your U.S. dollar into Ethereum or Bitcoin, and then convert it back. There's always going to be very
Hmm.
high transaction fees that the exchanges charge, and
Okay.
and then you might have issues with more bank transactions and things like that. So stablecoin was created so that you can just uh, swap your non-stable coin like Ethereum or Bitcoin into
Hmm.
a stable coin like Tether, and it's just a convenience so that you can not be exposed to the volatile asset and switch into this the asset that's you know stable relative to the US dollar. So
Okay.
back
So
in
then
yeah, go on.
like for us, it's like for me, speaking about all the degens out there, like so why do you need so many of them? Like you always hear about, oh, this protocol has this stablecoin, that protocol has that stablecoin, but then they're all part of the same chain sometimes. Like I get it if there's like different chains that you need
Yeah.
different stablecoins if you want to remain in the chain, so you don't have to bridge here and bridge there. But why does it seem like every other protocol would like to make their own stablecoin?
Yeah, so I mean, I think it's not a matter of why we need so many stable coins, but just that the whole decentralized Web3 allows anyone to come up with a stablecoin if they wanted to. Okay, so
Okay.
then what we find is that people try to come up with innovative ways to deal with some of the problems that we identified earlier. So with when they looked at Tether and USDC, they realized, okay, these are very centralized coins, and then there were these protocols that came out that tried to look at whether they can come up with a decentralized stablecoin. So there's a stablecoin called DAI from MakerDAO. Have you?
Yeah.
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 Okay. So with
I think
DAI,
that's Polygon, right?
so no, so DAI is they're available on multi-chain. So they're one of the
Oh,
most
multi-chain.
popular
Okay.
decentralized stablecoins out there. They are the stablecoin it's basically minted whenever someone takes a loan out on the MakerDAO protocol.
Okay.
Okay. So these will be asset-backed stablecoins because they are collateralized by the loans. So on MakerDAO, depending on which asset is used to serve as the collateral, there would be different
Mm-hmm.
collateral ratios for that. But Maker,
Okay.
it used to be one of the most decentralized protocols and stable coins available, but
Mm-hmm.
there was one time where there was like a lot of market volatility, and the Maker DAO had to make a tough decision. So they ended up allowing USDC as collateral, and
Oh,
now after that, what people did was they just used USDC as a
yeah.
collateral, and because USDC is a centralized stablecoin, that in effect, made the DAI stablecoin far less decentralized than it
Less
used to
central,
be.
less
Yeah,
decentralized.
yeah.
Okay.
So a lot of people, they like with stablecoins, you really don't want them to fail. Like if the whole idea of the decentralized stablecoin was that they're tied to um, they're tied to the safer cryptocurrencies out there. So that they're backed
Okay.
by digital assets rather than backed by like US dollars.
Mm-hmm.
And the DAO evaluates which digital asset they want to allow to be used as collateral. And so the idea is that it would be decentralized because all of these assets that are backing it are supposed to be decentralized cryptocurrencies. But unfortunately, once they introduced the USDC, then it really kind of jeopardized that selling point.
Mm-hmm.
And
Yeah.
and you really don't want them to fail. Like being decentralized means that it's less likely to fail. And
Yeah.
when USDC was added, that increased the risk of, if USDC itself failed, maybe that would drag DAI along with it. And
Yeah.
so it's with that, other stable coins emerged
Mm-hmm.
because people realized um, it's quite difficult to design a stable coin, and they wanted to
Okay.
solve some of these problems with how to maintain a stable peg.
Okay. Okay. So let's say like we look at two different stablecoins. You might have to help me out to choose which two to look at. Like ideally they're quite different. Like where do you quickly look up what they're backed by? Like is there like some kind of white paper out there for the stablecoins?
Okay, so you really have to just see who is issuing that stable coin, and
Okay.
there probably is. I haven't read the Tether white paper myself, but
Okay.
this is probably something you can just kind of do your own research, Google, and see some of the
Mm.
history behind it. I think
Mm-hmm.
uh, it's more important to focus on like the big differences between like the collateral backed
Yeah.
stable coins and these other ones. Like the newer ones are a lot of the ones that are popular now are actually algorithmic stable coins. So one
Okay.
of the most popular ones, actually, they are now more popular than DAI. So DAI was the most popular um, decentralized stablecoin, but now
Mm-hmm.
it's UST. So UST is,
UST.
yeah. So not to be confused with USDT, which is Tether. UST
Uh-huh.
is the Terra USD stablecoin. Okay, so Terra
Yeah.
is um, a blockchain that I think we mentioned last episode, and it's their stablecoin is tied to their native token on their blockchain, so that if the demand for the stablecoin goes up, then the blockchain um, will actually mint more stablecoin and buy Luna. Okay, and basically
Okay.
shift the volatility that would have otherwise happened on UST and move it to Luna and vice versa.
Hmm. Okay. So how how would you use it besides just, hey, what we talked to before, just putting it there to put it on the sidelines as a reserve? Like, is there ways to use them or some kind of strategies that you can employ?
So a stablecoin is there's not really anything super interesting when it comes to
Mm,
stablecoins, right? Because they're meant to be stable. So I can understand why, as a degen, you may not be like super interested in it. However, um, like one of the things that you can do is you can earn a yield, and these days,
yeah.
the highest yield right now that I know of, just just depositing a stable coin into a DeFi lending platform would be the UST on Anchor, which pays about
Mm,
20%. So that's
yeah.
like a really good yield on a stable coin. I think a lot of people, they they hear
Jumped
20
onto it.
they hear 20% in crypto over a year, and they're not like too excited over it. Like if I told you, hey, you can put your money on Anchor and earn 20% in a year, you're
Yeah.
probably not super excited about that, as a degen play. But
Uh-huh.
when you compare against just putting US dollar in a bank,
Yeah.
that's the real comparison. And there are degen plays that you can make that involve stablecoins. So one of the
Yeah.
you mentioned this stablecoin called Magic Internet Money, right? It's the
Yeah.
MIM stablecoin. So this is a stablecoin issued by a protocol called Abracadabra.
Hmm.
Uh, so on Abracadabra, you can actually borrow their you can deposit UST, and you can
Yeah.
borrow their Magic Internet Money. So you can borrow MIM, and then
Hmm.
um, you can swap it for more UST, deposit it at, and you can kind of loop it 5 times.
Yeah.
So they call this the degen box, and you can go on Abracadabra and you can play around with that, um, and you can basically turn that 20% yield into over 100% yield.
Mm.
So these are
So,
not without risks, right? Like
yeah.
um, stable coins are, although they try to maintain a peg to a dollar, if you look at um, like a price chart of these stable coins, you will see that they generally do fluctuate. Um,
Yeah.
so sometimes they trade over $1 and sometimes they trade under $1.
Yeah.
But generally they try to keep within like 5% of that $1 mark. Uh,
Okay. So I'm gonna share a pretty dumb experience when I first started. So I was like, oh, stablecoins, they're pegged to the dollar. Okay, I guess they're really safe, right? So then when I started, I told you, right, I really wanted to try farming, right? So when you're farming, you're usually going for a pair where you have to buy 50-50 of each one. So I was looking at these like APYs and I was like, oh, look, this is a pretty high APY. It's like 100 and something. Okay, and then I looked at the pair. It was like one was a stable coin and the other was some altcoin, right? You probably didn't even know what it was. I probably knew it wasn't as bad. So then I went into it thinking that it's safe because, hey, at least one of the currency is safe. Then maybe on average, we're good. And maybe like the 100 and something APY, maybe I'll get half of that, right? Or whatever. So lo and behold, I go in, and then sooner or later, I realize something called like impermanent loss, right?
yeah.
And then when I read about it, oh my gosh. So if you're farming and one of your coin is stable coin, you're like, it's dumb because then you're asking for impermanent loss.
And
Yeah.
the problem with these trades is that you're basically trading against the trader, and if you're if one side of those assets fall in value, you basically are buying up that asset,
Yeah.
as it falls in value. And
Because you have to maintain 50-50 of each.
so like instead of instead of providing liquidity to something like USDT and Ethereum, you can provide liquidity to like a USDC USDT pool.
Mhm.
Okay, and that would be much less risk in terms of that impermanent loss,
Yeah.
and you would still be able to gain the trading fees. So like, yeah, basically when you provide liquidity to these liquidity pools, as an investor, what you're hoping to get is you're hoping to get like a share of the trading fees whenever
Mhm.
someone is trying to swap one asset for another, using the liquidity that you've provided.
I
Normally,
guess what I wanted to say is don't do farming with one stable coin and one non-stable coin. It's kind of dumb.
yeah, I mean it is a good, it's good for people to know what you can do with a stable coin.
Yeah.
um, and yield farming is definitely like one of those things, because people do, the reason why stablecoins exist is so that people who want to swap out of a riskier asset,
Hmm.
can swap into a stablecoin, and they need to uh, they need to do that at an exchange, and they'll pay a fee. Usually it's 0.3%, something like that,
Okay.
and the vast majority of that fee will go to like a liquidity pool. Unfortunately,
Hmm.
my experience is that the typical trading fee typically does not cover the kind of impermanent loss that you see for a liquidity
Mm.
provider. Okay, so uh, and this is why most protocols actually will incentivize people who do yield farming. Okay, so yeah, a good idea is if you're just starting farming, I would stick to some of the stable coin pairs, or look at those, because that's one
Yeah.
way to get a little bit more yield. Um,
Hmm.
if you are looking to just hold some stable coins, especially when you think the market may be going down, and you want to be in stable coins, but you also still
Mm.
want to make like a decent return.
Yeah.
Then to compare the rates that you get on just lending your stable coin,
Yeah.
Versus if you were to have to swap half of your stablecoin into a different stablecoin, and
Yeah.
then um, and then yield farming that stablecoin pair. Now there is a risk, right? Because with all stablecoins, you're basically, the biggest fear is that it depegs,
Yeah.
which means that it no longer can maintain its one-to-one exchange rate with the
Hmm.
US dollar. And even if you were in a stablecoin pair, now you're exposed to two different stablecoins. So if
Yeah.
either one of them breaks its peg, and let's say it like even goes to zero,
Yeah.
you as a liquidity provider, you are constantly buying the one that's falling. So you would end up losing everything if one of the two go to zero and you haven't been paying attention.
So has it happened before? Like a stable coin, a well-known one that's gone to zero?
Um, so there, I mean that's a good question. Off the top of my head, I I I don't know like any like truly popular ones that have, but they have
Okay.
lost this peg, um, like for a significant duration of time.
Okay. So like we can still sort of think as stable coin as something like a safe
Yeah, you caught me off
coin to
guard there.
hold.
I'm trying to think um,
That's what I was wondering. So the history of why I'm asking this question is that there was one point where I was holding Magic Internet Money as a stable coin to be on the sidelines, and
yeah.
then the whole like crazy sell-off and everything, and like the owner of the abracadabra money thing was being accused of trying to rug people, and I was like, oh my gosh! So I quickly switched out of it, and then later on, I'm like, oh, it's still holding.
So a riskier stable coin would,
Hmm.
if they are the type of stable coins like MIM or DAI, where they're collateral backed stable coins, um,
Hmm.
they will lose their value. They will lose their peg if the collateral that they're holding loses value, right?
Okay.
So usually they'll have a collateral, like a collateral ratio of
Hmm.
70 or 80%, right? So
Yeah.
if you have $100 of Ethereum and it falls to, like, they'll only allow you to mint maybe 70 or $80 of that stable coin if you as a maximum. So
Yeah.
then if your Ethereum falls in value, they would that protocol basically would liquidate your position.
You get margin called
You
basically.
you basically get margin called. But what happens is, so what happens in a flash crash, if the price
Yeah.
of Ethereum falls 80% very quickly, and the protocol is unable to kind of liquidate that position quick enough, right? Then that protocol could end up with losses.
Mm. Okay.
So then
So
then that would be a situation where that stable coin is now no longer fully backed.
yeah.
Then it would then begin to lose its peg. So there are fully backed stable coins, and then there are these partially backed stable coins. Um,
Oh, so,
there,
so
yeah,
when they're partially backed, like for example, like they're 70% backed. What's the other 30%?
nothing. That's what it
Oh,
means by
nothing.
yeah. That's what it means by it being
Oh,
partially backed. But
okay.
it's kind of like it's kind of like the currency that you use with in a bank too, because um, that is done in a fractional reserve. So a bank typically doesn't have 100%
Hmm.
of its
Their
loans that
money
are
reserved for
backed.
you. Like
Yeah.
most of it is lent out,
So
right?
the traditional finance space is actually not fully backed. It's
Mm.
fractional reserve, and so people have tried fractional reserve type of stablecoin, like a money market
Yeah.
protocol, but they haven't seemed to work really well. So
Yeah.
like there's the Iron Finance protocol that I can think of where they had kind of like a bank run because because they were not fully backed.
Fully backed.
Yeah, because the problem with being partially backed is that once people lose, so if you're not fully backed, then whatever is not fully backed is just backed by the faith people have in
Yeah.
your protocol, and if people start losing faith in that stablecoin, then the whole thing collapses.
So since the whole point of a stablecoin is just so that you have a safe place to put your crypto in when you're on the sidelines or not DJing into anything, then you probably should look at something that's fully backed.
So it's really really interesting. So with Tether,
Yeah.
we know that they're not fully backed,
Oh, okay.
but if you look at Tether's price, it is the stablecoin which has basically been maintaining its peg successfully, and people just seem to give it a dollar's worth of value.
Mm.
Okay, so Tether FUD has always been around, so people and because there has always been this question of what is it backed by, and most people who are coming from a traditional finance
Hmm.
perspective, that's one of the first things that they want to know, whether if you're going to call yourself some kind of money market fund,
Yeah.
you want it, you like people want to know what kind of assets are
Hmm.
backing that stablecoin. So because it was always difficult to find out what was backing Tether,
Yeah.
and it was only like in 2021 when we found out a lot more about Tether, which was very concerning to a lot of people. But guess
Yeah.
what? Like Tether's price never changed,
Oh,
and it's because like it really serves a very important infrastructural role in the crypto space. It's almost as if there's even less risk there because people like what we give to like what backs a US dollar. At the end of the day, it used to be backed by gold, but now
it's
it's
not
just backed by
anymore.
the the faith people have in the US government. Its
Yeah.
ability to tax its citizens,
Yeah.
and so it's but at the end of the day it's like about this faith. So people seem to uh, have faith that one tether is worth a dollar,
Yeah.
and it just seems to be that way. It's
Yeah.
like really hard to explain, but maybe because it just serves such a vital function.
Like, do you mind if you can like just maybe like release a little bit of what do you mean by like the infrastructure of Tether, like how it's so like deep intertwined with the whole crypto industry that if it dies, everything dies. Could you just give like a little small summary of like why that is?
Because it has the most liquidity, so the most pairs, like when we talked about swapping one coin to
Hmm.
another, like if um, the the pairs that have the most liquidity
Yeah,
are all
all
paired
involve
against
Tether.
like yeah, so tether makes up a lot of that liquidity,
Oh, interesting.
right?
And what would you say like is your like don't I won't say recommended, but what's your view on like this whole uh the whole stablecoin thing? Like, are they all gonna just merge into one because there's just no need for that many? Or like what's happening?
I think you've heard about like central bank digital currencies. All countries are pretty much looking into um, their central bank digital currencies, of some sort. And the U.S. definitely, there's definitely one that's coming. Uh, some people have been concerned, whether if a central bank digital currency comes out, is it going to replace all stable coins?
Mm.
I don't think anyone knows at the moment, but I personally don't think so. Um, the I don't think that the U.S. government or the U.S. Federal Reserve, like, I don't think that they're interested in operating the payment side, right,
Okay.
of things. So you can think of like a real good use case of stable coins in the Web3 future
Yeah.
is if you wanted to buy something on the internet, you can pay for it with a stable coin, right? And
Yeah.
um, if if everybody had to pay with um, a kind of central bank digital currency, then the U.S. government or the whoever, whatever official body is issuing and managing that CBDC would have to also you know manage all the infrastructure that
Mm.
is related to accepting payments by merchants.
Yeah.
Okay, so I think that my personal view is that it's more likely that you have companies like Circle that will manage because basically that's what they're doing. Like if
That's what
you're
they're trying to do, right?
that's what they're trying to do, right? Like the traditional Web 2 equivalent would be something like PayPal, right? So
Okay.
if you're an online merchant, you can have you can accept PayPal. Um, you can use their payment channel, and somebody
Mm.
can have a PayPal account and pay you. So in the same way, you can imagine somebody with USDC. If they go to a merchant, the merchant is set up to receive USDC, and uh, they can convert their USDC back into whatever currency they need.
Hmm.
Let's say it's US dollar, and it goes into the merchant's bank account. That seems like it's something for either banks or
Yeah.
companies like Circle
Yeah.
and PayPal to do, rather than the government doing it directly. And the
Yeah.
reason why I think so is because they haven't done it with like PayPal and Square and all these
Yeah.
things. The government has really left it um, to businesses to handle.
No, sounds good. Sounds good. I think that's all I have for today regarding stablecoins. A bit out of character for me, but definitely something I was looking at during this whole like crash.
Yeah, I think we did touch on quite a bit about stablecoins. It's hard to, like, if anybody has questions, feel free to leave a comment or get in touch with us, and I'll I would love to kind of look into that for you.
Yeah,
Um,
like your questions usually spark even more things I want to know about. Because then usually while researching on the answer, you'll find like, oh, that's how this works, right?
mhm.
So please leave us a message on any questions and let's talk about it, right?
Yeah, and a lot of these things, I think will be if we have time to dive deep into individual stable coins, there each one of them can be an entire kind of tutorial
Mm,
video on their own.
yeah.
But today I just wanted to kind of introduce them to some of our viewers who maybe just getting into cryptocurrencies and they haven't even heard of stable coins. They're thinking, okay, so if I buy crypto and I think it's I think Bitcoin or Ethereum is going to fall, what do I do? Do I have to swap it back
Yeah.
to your
To
fiat
fiat
currency?
currency.
Yeah, but no, like
Yeah.
so there are these stablecoin options that can give you interest when you're not, so when you're like taking shelter from the more volatile assets, and
Right.
then so you just have to. There are a lot of them out there, and they work very differently, and so it's definitely important to do your research and find out as much as you can about the different types.
All right.
All right.
Yep. And that's it from me
All
for
right,
today.
that's it from us this week, and have a good weekend, everyone.
All right. Cheers, guys. Until next week.
Until next week.